This is Under One Roof MTL on CJD 800. We are demystifying home ownership 1 week at a time. My name is Robin Flynn, joined as always by Fred Pichette and Martin Spalding of Fred and Martin Mortgages. Good afternoon, gentlemen.
Good afternoon, Robin. Happy Mother's Day.
Thank you. Happy Mother's Day to the women in your lives, I suppose.
Thank you. Yes, thanks.
I hope everybody remembered to go and get some flowers and a card.
Exactly.
Not too late.
Not too late. LJ Aguinaga of LJ Realties. Hey, LJ, hope you're treating the mother of your child special today.
100%. I love Mother's Day. It's always a great day to show our thanks for all the wonderful things that mothers do around us every single day.
Exactly. So happy Mother's Day to you. Thanks for spending some of your afternoon with us. We're going to start with our trivia question of the week because what better way to celebrate Mother's Day than by receiving delicious cookies from Felix and Norton? If you think you know the answer, 514-790-0800. Text it in with your name. What kind of mortgage allows a homeowner to borrow against the value of their home while still living in it? If you think you know the answer, 514-790-0800. And please include your name. We always appreciate that. A lot going on in the news this week. One of the headlines that really jumped out to me was both fixed and variable rate mortgages are getting pricier. Is that what you guys are seeing as well? I mean, economic uncertainty seems to be the norm at this point, even after Mr. Carney went to Washington. Martin, what are you seeing? Are fixed and variable rates going up?
Well, unfortunately, at the end of the week, we started getting emails from the major lenders announcing that fixed rates were going up. Not substantially, but we're going up. And because we go back to the bond yields, we go back to the bond market, the bond yields are ticking up. So what happens is when the bond yields start to tick up, they start to pull up fixed rates. So we were a little disappointed or a little distraught when we started seeing the emails come in. And, you know, it's funny because we qualified or pre-qualified a client about a week and a half ago, and a pre-qualification rate is a little bit higher than a regular rate. But today, that rate looks pretty good. So bottom line, it's if you're thinking going into the market, if your mortgage is up for renewal, there's nothing wrong with starting early and locking in a rate, and the rate can be held for you for 120 days. So if we think rates are going to continue to tick up, maybe it's a good time to act.
Fred, do you think that fixed rates are going to keep going up?
I think they're going to remain stable up to fall market because, as Martin says, I think the bond yield will start to go down. Probably not during the summer, but in fall. If you look at the forecast, I think the strategy right now or thinking going variable could be a very valuable option. I was reading most of the economists of the major Canadian banks are agree that the rate cuts for the Bank in Canada will continue between a 0.5 to 1% either this year or beginning of 2026. I agree with Martin. The spread, the bank reduced their spread, meaning they increased their variable rate because they reduce the discount. But it could be a good option if your tolerance to the risk is high, or are you okay with that?
So if you're like LJ and I know we're kind of in the same boat with our respective mortgages. We have variable rates. What would you recommend to someone like me or like LJ whose mortgage perhaps is coming up for renewal in the next couple of years? Should we stick with variable or should we consider a fixed rate at this point?
Well, Robin, that's a very good question. It's really, if you're on a very tight budget and you can feel an increase in your payment, the answer is stay with your fixed rate. But again, if I read between the lines what we see, where the economy is going, and everybody knows about the tariff and the uncertainty in the economy, I think going variable give you flexibility and potentially saving of interest, even though the discount is not that high, knowing that for one time all the economists are agree that we're going to have a potential rate cut, I think could be a good solution. But it's really up to you,
For sure. LJ,
Sorry.
I want to loop LJ into the
Of course.
discussion.
Go.
Yeah. Okay. So, LJ, I know the Scotiabank is now expecting the Bank of Canada will make more rate cuts as we head into 2026. So, how are you feeling right now as both a variable rate mortgage and somebody who deals with people who are purchasing real estate on the regular?
So there's a couple different things I want to touch on here. Finally, the Scotiabank analyst or economist, pardon me, is actually predicting that things will decrease. Now, he did declare that he suspects the decreases are going to happen in 2026, not 2025, which does align with what he's been saying for the last couple of months. Every single bank has a different opinion on this, and I think that due to all the instabilities that we're seeing in the market and just the uncertainty, which I know is a word we've been using a lot on air lately, but it's just the reality of what we're being faced with right now. People don't know, and I think that obviously every day we get a new update on where the tariff war is going, who's negotiated with who, what's happening now, how there's going to be a shortage of inventory in shopping centers very, very soon. And with all of this uncertainty, it just leads to people not knowing what's going to happen next, unfortunately. In terms of what I'm seeing people taking, I mean, the conversation has really shifted from one of taking a gamble to one of, you know what, if it's my principal residence, I know I'm going to get this rate. If it's a slightly larger mortgage than I was expecting to have originally, I want to be safe in this mortgage and I don't want to have to be worrying about it going up or down. I think that a lot of consumers are still feeling a little bit burnt by what we experienced over the last couple of years with the variable rates. And as people are going into larger properties with larger mortgages, they're being a little bit more conservative. If they're staying at a price point that they're very comfortable with, then they might take that risk on that variable, hoping that it comes down because they've given themselves a bit of buffer. But if they are on the upper end of their budget or really kind of going to the limit of their budget, then I'm seeing a lot of people take fixed to avoid any potential risks.
So I just want to build on that. So we're referring to an article that Scotiabank was quoted in probably Wednesday of last week. Now on Friday morning, another article comes out, and the article stated basically that odds of a 25 basis points rate cut in June are rising as the impact of tariffs start to take hold along with a weakening labor market. This is fueling expectations that the Bank of Canada rate cut on June 4th will happen. So your guess is as good as mine. You've got economists that live and breathe this day in, day out, and within a 2-day gap, no one really knows where this is all going. And that's what I mentioned last week. The unpredictability of the economy right now is really making it tough to take any decisions based on any real facts or data.
Yep. I guess the game right now is play wait and see. The next rate cut is coming up in June, so we'll see what happens. If you're not sure if you should wait, should you buy now? Should you plan ahead? Give LJ a call at 514-500-4040. He will help you figure it all out. Still to come, we'll tell you what questions you should be asking both yourself and your mortgage broker before you get ready for renewal time. That's coming up after we check traffic at the CJD 800 Traffic Center.
Is your mortgage up for renewal and your rate has doubled and you're wondering what to do? This is your Mortgage Minute. If your mortgage is renewing this year, brace yourself. You could be in for a serious financial shock. Many who locked in ultra low rates during the pandemic, some as low as 1.5%, are now facing renewals at 4.5% or higher. That kind of jump can mean an increase of $500 to $800 a month on a typical mortgage. That's what the industry is calling payment shock. And with over 50% of mortgages set to renew by 2026, this is becoming a widespread headache for many. So what can you do to soften the blow? Well, you might consider extending your amortization, consolidating debt, or even switching lenders. And yes, there are ways to do that without having to requalify under the stress test.
This is Under One Roof MTL on CJD 800. I'm Robin, that's Fred, that's Martin, that is LJ. We are with you until 1 p.m. How to avoid payment shock at renewal time. You just heard Martin tee it up in his Mortgage Minute, but there is so much to unpack here. So, Martin, let's sort of start with you. When we talk about payment shock, what does that even mean, first of all?
So let's set the table. And actually, Fred was very active during COVID because it was the wild west of lower rates, and everybody hopped on the bandwagon. So 5 years later, believe it or not, 5 years later, this year, approximately 1.2 million Canadian mortgages up for renewal. And with 85% being secured during COVID, many homeowners are getting ready for the sticker shock. So in the mortgage minute, we use an example of people signing for 1.5%. Well, they're renewing at 4.5%. So that 4.5% based on a $400,000 mortgage could be $400 to $800 more on a monthly basis. So what do? Because you got no choice, right? You enjoy these 5 years of low interest rates and low payments, and unfortunately, it's come time to renew. And you want to keep your house, so you're going to have to step up and pay these new rates. So we often say start early. So I was talking about pre-qualifying somebody. This person is not going to be in the market for 4 to 6 months, but she wanted to be pre-qualified. And that rate, that pre-qualification rate, when we sent it to her, we were trying to explain, well, if rates go down, we'll be able to modify, we'll be able to do this. But all of a sudden, that rate looks pretty good subsequent to the rate increases we received this week. So start early. Always start early. You can compare rates, you can negotiate, and you can even switch. So if your current lender is not offering something that you think is decent, shop around or give us a call and we'll shop around for you.
Now, if you decide to switch lenders, Fred, do you have to requalify using the stress test?
Well, technically, the answer is if you're just doing a switch, you don't have to qualify with the stress test. However, you still have to qualify based on the interest rate that you're going to get, let's say the 5 years fixed rate. But you don't have to apply the stress test again, which is that's new in the mortgage business. Also, just to say what Martin was saying is, even if you start early, the first thing I would do, I would make a budget. Okay, my payment was $1,500 a month when I had a rate of 1.5. Let's say now my payment goes from $1,500 to $2,200 a month. If I keep the same remaining amortization period, do I feel comfortable with that payment? If the answer is not, and a lot of people, they don't make budget, but if they make their budget every month, they will have the answer. Maybe it's better for you to refinance your property, extend your amortization period from, let's say it was 15 years left, back to 25, it doesn't really matter, or even 30 years, and get a lower monthly payment possible. You will really help your cash flow every month, and it might be a good solution. These things are something that Martin and we work a lot with our client to see, tell me about you, tell me where you stand, what's your needs, and we'll give you some option. And I think by starting early and making a budget, you're going in the right direction.
And so there was a survey done based on this sticker shock that a lot of people are experiencing. And the numbers came out, and they said 70% of Quebec respondents plan to reduce or eliminate discretionary spending. 31% intend to cut back on savings and investments, which is not always great, but when you're in a cash crunch, you got to do what you got to do. And 29% plan to reduce travel expenses. So Balconville instead of going to wherever you'd like to have your vacations.
We already know that Canadians are not going to the US, right? We've seen those numbers decrease significantly if we can't afford to go anywhere else, because travel other than going to the US tends to be a bit more expensive. Your mortgage is going up. LJ, are people coming to you saying, I need to downsize because I can no longer afford my house now that my mortgage interest rate is increasing?
So the reality is I have not seen too many people saying that they have to downsize. And while we talk about all this, it's important to kind of circle back to the stress test. Even when people were taking mortgages at 1.5%, 2%, everybody was being approved at a rate of 5.25%. Whether people are going to be wanting to pay those rates or close to those rates right now or not is a completely different story. But from a ratios perspective, from a debt service coverage perspective, they could do it. Now, what are they going to give up instead? Is it those trips? Is it taking a nice vacation on Balconville, as Martin just put it? It's the first time I hear that expression. Thank you for adding that to my dictionary. Is it going to be less extracurriculars for the kids? Is it going to be less dining out? Is it going to be all the things that people have been doing a lot of for the last 3-4 years? I believe it's probably going to be a bit more of that. Is there some people who might readjust? Yes, but I think more of the readjustment's going to come from divorces, separations, critical life events that are going to really impact people's living situations. I don't think too many people are going to be prepared to sell their home, move their family, do all these things unless it's really, really dire. I think they're really going to be more likely to adjust their current quality of life and their standard of living to make sure they can stay in that property, keep their kids in their current schools, and not really shift the family dynamic as much as they could. And that's just going to mean more home cooked meals at home and less travel down south, wherever that might be. Talking about other vacation destinations, I'd be curious to see how Caribbean destinations are doing. I think all inclusives might become popular again. You have one fixed fee for your flight, for your food, for your lodging, for everything. You know exactly how much you're going to spend, and that might be the go-to option right now. You don't have to worry about currencies or anything else, and it avoids the U.S. for the most part, right? So I'm curious to see how that's going to play out as well.
I think you need to also be careful not to subsidize your lifestyle because you've got a higher mortgage payment by loading up your credit cards. That's a very slippery slope. And credit cards, we remember you'll pay 22% amortized daily. The better thing to do is to refinance, consolidate that debt, stretch out the amortization so that the payments that you're making monthly are acceptable.
To find out what your options are, you should get in touch with Fred and Martin. You can go to their website at fredandmartin.com. Okay, so you've decided to purchase an investment property. Now what? We're going to discuss after the news. You're listening to Under One Roof MTL on CJD 800. My name is Robin Flynn, joined by LJ Aguinaga of LJ Realties, Fred Pichette, and Martin Spalding of Fred and Martin Mortgages. All right, so you've decided you want to buy your first investment property. What should you know before you go into this? Now, LJ, I am sure you are a fountain of knowledge on this subject because I imagine the rules are a little bit different when you're buying, a revenue property versus a primary residence. So what are some of the things that people should be aware of before they make this investment?
There's so many things that somebody should be aware of. The first thing I will always recommend is sit down and take a meeting with me where we can go over your exact situation and we can really do the best planning for your situation, because it really varies from person to person and there's so many different variables that it's hard to give a one size fits all answer on air right now. But the reality is, if we start with financing, depending on the size of the property that we're looking to get into, financing is very different. If we're going with residential financing or if we're going with commercial financing, we have two very different products out there. If we're looking at potentially a CMHC insured commercial loan or an MLI Select program, these are all very particular programs that are not at all like your traditional lending right now. So really understanding what's our avatar of the perfect property that we're going to go after. And then from there, we're going to understand how we're going to finance it. And that financing looks very different if you're, let's say, a high earner versus you're somebody who's really living off of investments. There's going to be different products available to you, and there's going to be different ways of going about it. So there are so many different products out there in order to get people into real estate, especially into multifamily real estate, that it's really worth sitting down with either Fred, Martin, myself to kind of discuss what those options look like for you. And then from there, we really build out, okay, well, are we looking for a cash flow play? Are we looking for an optimization play? Are we looking for an appreciation play? What is it that we're really looking for? What is the goal with this property? It's not just that I want to own a piece of real estate because that's been my dream. That's the great first step. But what do we want to do with this? Do we want to retire on this? Do we want to have extra income? Do we want to take the next 5 to 10 years to really improve the property to get higher rents or to have a better asset? And then once we've kind of established what's going to work with you, because I have some clients that are a lot more handy that can do the work themselves. I've got some clients that are very hands off. Maybe they're a lawyer, a doctor, and they just really want to have a passive investment. They want to hire a Plex doctor to manage it for them. And they just want to make sure that they're diversified in their investments and have a piece in real estate itself, but don't want to deal with the day to day. So once we have a better idea of what kind of investor you're looking to be, at that point, we're going to sit down and start looking for the properties that align with your expectations and with the reality of the market as well, right? So we're going to kind of highlight what we think is going to be feasible. We're going to go through the financing options, and then we start visiting. And once we start visiting is when we really get to refine what kind of an investor you're actually going to be. Because a lot of people say, yeah, it's okay. I don't care how pretty or how ugly it is. And then I walk them into a property and they're like, oh, I would never live in this place. I could never buy this. I would never imagine anybody being able to live in here. I say, I get it, but you're not going to live here. And plenty of people already live here and more people will live here, right? So changing that lens for people is a big part of it as well. But some people are not prepared to do that. So that's why the visits are so important. Martin, you had a question for me.
Yeah, in your experience, what are the most common mistakes that first-time real estate investors make that they could have avoided by sitting down with a guy like you?
I have a whole list about that. I'm actually releasing a video on YouTube in the next months with that exact topic, but if I had to give you a couple of items right now. First of all, not understanding the financing process. So kind of like we just discussed, understanding what financing is available to you. Next is skipping the due diligence. Some people in competitive markets will say, I don't want to do an inspection. I want to make sure I get the property. And like, that's a huge no-no. It's a huge mistake. Unless you're a contractor, developer, or very, very, very experienced investor, you don't want to skip any part of your due diligence. It's super important. Environmental testing, stuff of that nature, depending on the size of the property, is all critical to the transaction. The next thing is not ensuring that you've priced in a couple of rate hikes along the way, right? If you're expecting X cash flow and all of a sudden rates go up and the cash flow is no longer there, I've seen one client in particular, or somebody that I heard of even, was they were originally a professional. They had a nice salary. They started buying properties. They wanted then to shift to be a full-time real estate investor. They made the shift to real estate investor. They dropped their salaried income, and everything was kind of going nice for a year or two. And all of a sudden, rate hike shifts. Cash flow changes dramatically. All of a sudden, what they were used to living off of was no longer there. All of a sudden, they're kind of in a panic, trying to figure out: do I go back to work? How do I reinvent myself now? Do I have to sell a property? It's not a good time to sell a property because the market's down right now, and just kind of going from there. So making sure that you've given yourself enough reserves and that you effectively have not over leveraged yourself is part of that conversation as well. These are some of the things that I can kind of spit out you right now, mistakes I see people make along the way. Yes, Martin.
So follow-up question on that. Should you model out when you're about to make the acquisition of an investment property, say a duplex, triplex, whatever it may be, that the building should carry itself? In other words, you shouldn't have any out of pocket. And how do you model that out to make sure that it's not costing you $200 a month when the whole thing should be carrying itself?
I mean, how you model out by just putting together a simple pro forma on Excel. We have a calculator that we share with people that allows them to kind of put in all the numbers, expect what the carrying costs are going to be, what the monthly income is going to be, and that'll give you a scenario. Yeah, 100%. The property should be self-sufficient because that's what actually makes it an asset. If you have to be going out of your pocket into it every single month, it's no longer an asset. It's actually a drain on you. It's a liability, unfortunately. So that's the big difference. A lot of people say, oh, yeah, I have all these assets, but if they have to put money into all of them every single month, they have a lot of liabilities. They don't have a lot of assets. So I am okay with buying an asset from time to time that is currently not cash flowing, but we have a plan that in the next 12 to 18 months, it will be turned around, it will be optimized, it will be cash flowing there. There's a very clear path as to how we're going to get it there. And only under that criteria, we're okay moving forward with that type of investment. But that's usually not your first in time investor. You know, they usually understand a little bit in the growing pains or the learning process. And once they have a bit of experience, they're like, all right, now I understand what I'm going to do. I might do cash for keys. I might be taking on a vacant apartment, so there's no cash flow up front. I'm going to take 3 months to renovate it, and then I know I'm expecting to get this cash flow, even if it takes me an extra 3 months to rent it out because it's not the best time of the year. I'm going to be okay, but I've planned in the 6 months of carrying costs, etc. So there are scenarios where being at a loss for cash flow upfront makes sense. But again, it's very much a buyer beware. That's not the goal. That's not the gold standard. And buying something just because it's supposed to appreciate is not the way we do business. You know, it's got to carry itself throughout this process. And that way you want to take advantage of the three pillars of real estate investing, where we have the cash flow income, we're going to have the appreciation, and we're going to have the tax benefits. You can depreciate the property if you want to kind of write off additional taxes if you'd like as well. So when you can really anchor on those three things for an investment property, that's when you're truly taking advantage of all the levers on real estate transactions. And that's when you can really get the full benefit of real estate.
A couple of years ago was very popular, people buying property to flip them. It's just something that you think it's a good investment, flipping properties to try to make a quick profit.
I think it really depends on who you are. If you're a handy person, if you're a contractor, I've spoken to a lot of contractors and said, you know what, I've been a contractor for the last decade, and I don't like working with certain clients. They're too demanding. We don't get along, etc. So I'm just going to dedicate myself to doing flips. And I'll see contractors sometimes do, let's say, 2 or 3 flips a year, and they effectively are working for themselves. So they take pride in their work. They get everything at cost, so they get economies of scale on that front, and they are very much okay turning a $30,000 to $50,000 profit per property, and that's enough for them because they keep their team working. They can take that profit to live off of. You do it 2, 3, 4 times a year, you have some pretty decent income coming in that way. Under that scenario, it makes sense. On average, on the island of Montreal, I'd say there's usually not enough kind of juice left for the squeeze. It's just not worth it most of the time. Now, in the high-end market, sometimes you can buy a property that's significantly undervalued because it requires so much work and nobody wants to go into that endeavor. But in my experience with flipping, a lot of times there just isn't enough meat left on the bone. So I don't necessarily think it makes sense. There are always exceptions. I know people who've made great money with flipping, so it's not to knock it, but it really is market dependent and really opportunity dependent. If you do come across that great opportunity, by all means, go for it.
So now you've purchased your investment property and you don't want to do anything. You just want that passive income to roll in. Give the Plex Doctor a call, 514-709-6397. You can visit their website at plexdr.com. Coming up, our property of the week, plus the answer to our trivia question. That's all coming up after we check traffic at the CJD 800 Traffic Center. You're listening to Under One Roof MTL on CJD 800. I'm Robin, that's Fred, that's Martin, that's LJ. We are with you until 1 p.m. We always visit a property around this time in the show. So, LJ, what's our property for this week?
Are you looking for your dream home in one of Montreal's hottest neighborhoods? Welcome to 2292 Rue de Villiers, a stunning, fully renovated 2-bedroom home just steps away from the Lachine Canal and Atwater Market. Enjoy a sun-filled open layout, designer kitchen with custom oak millwork, a spa-inspired bathroom, and a cozy wood-burning fireplace. Step outside to your private cedar deck and outdoor kitchen, perfect for entertaining all year round. Offered at $950,000, this home is a rare gem you don't want to miss. Call us at 514-500-4040 or visit ljrealties.com to book your private tour today. Now, my go-to restaurant for brunch or dinner that's just around the corner is McKiernan Luncheonette. I love going there with my family. The space is beautiful with super high ceilings and just a lot of room for the kids to run around. Lately, I've been getting the steak and eggs for breakfast or the whole chicken for dinner. Check them out next time you're in the area.
Love it. I'm pretty sure I saw this one on Instagram. You had a beautiful tour this week. It's gorgeous.
Every time he starts talking about these properties, I look them up, and this one looks immaculate. And
We were
it looks
featured
like
on
it's completely renovated inside. It's got a beautiful skylight, fireplace. Wow, maybe I'll make an offer.
It's got all the bells and whistles. Thank you. It was featured on Jolie Jolie. There's no garage. There's space in the back to make a driveway spot if you'd like. They've always parked out on the street in front, but the backyard is so big. And there is a back alley out there that you can definitely just put a driveway if you'd like back there.
And you said it was
Whoever designed
featured
it.
somewhere?
Yeah, it was featured on Jolie Jolie Design. It's a great kind of Quebec web design. They have a huge Facebook page, Instagram following, etc. And it was thrown on there. So yeah.
Awesome. Very,
You
very
know,
cool.
whoever designed it, yeah, they did it with a lot of taste, very elegant and very simple.
So we got to get to the answer to our trivia question of the week, brought to you by Felix and Norton Cookies. You should visit their store, by the way, at the Blue Haven Shopping Center, 3705 St. John's Boulevard in DDO. Our question this week: what kind of mortgage allows a homeowner to borrow against the value of their home while still living in it without requiring any payments? The answer is a reverse mortgage. A reverse mortgage. So what makes a reverse mortgage different from a HELOC, from a home equity line of credit?
Well, the difference, Robin, is when you have a reverse mortgage, you're not obliged to make any payment. When you have a HELOC, you're obliged to make the interest payment, the minimum interest payment every month, which is when you have when you're a senior and you have equity in your property, low income, and you went through your saving. Reverse mortgage, it's an excellent product that should be better known for seniors. People are always saying, oh, I'm scared they're going to take over my property. Not at all. It's really a tool to help you to have a beautiful life and enjoying the equity of your property. And it could be very helpful.
Excellent. What did we learn this week? I learned a lot, and as I'm sure you did as well. We learned that both fixed and variable rate mortgage could potentially be getting pricier. Fixed for sure, variable rate maybe. Variable rates could come down. Time will tell. We'll have to wait and see. We also learned that it's important to be prepared and plan ahead. If your mortgage is coming up for renewal and you want to reduce some of that sticker shock, get in touch with Fred and Martin. 6, even 12 months, guys? How far in advance should people be getting in touch with you?
Sooner the better.
Sooner the better. That is some good advice right there. So go check when your mortgage is coming up for maturity and get in touch with Fred and Martin. We also learned that the rules are a little bit different for investment properties versus primary residences. It's always best to consult with a real estate expert like LJ when you're going to make some of these big purchases, and he can help walk you through the process. That's pretty much it for us for this week. We will be back next Sunday at noon right here on CJD 800. In the meantime, if you want to learn more about the guys and the show, you can go to our website, underoneroofmtl.com, or you can get in touch with them individually. LJ, where do people go to get in touch with you?
You can check out our website, ljrealties.com. That's LJ Realties with an IES. Or on all socials with the handle LJ Aguinaga. That's LJAGUINAGA or LJ Realties. You can also call or text me at 514-500-4040. And if you're looking to free up some of your time, contact my property management company, Plex Doctor, to take over and give you back your time. You can find us at plexdr.com or reach out to my buddy Thierry at 514-709-6397.
Fred, Martin, where do people go to get in touch with you?
Well, it's funny. It's starting to stick because people are starting to tease me now because I try to say it 3 times and they go, oh, look, it's Martin. FredMartin.com, FredMartin.com, FredMartin.com. You're the guy. He said, yeah, it's FredMartin.com.
Awesome. So fredandmartin.com. You can book an interview, book a call directly with Fred and or Martin on the website. Their phone numbers are there. Everything that you need is at fredandmartin.com. If you missed anything, you can listen to this show in its entirety and every single show that we have ever done on the iHeartRadio app, Spotify, Apple, wherever you get your podcasts. There is a boatload of incredible information available to you. For LJ, Fred, and Martin, I'm Robin. Have a great Sunday and happy Mother's Day.
Happy Mother's Day.
Happy Mother's Day. Thank you so much for listening.